The US economy experienced its fastest growth in nearly 2 years during the third quarter, thanks to increased wages and strong consumer spending. This growth defied previous predictions of an impending recession that have been circulating since 2022, according to a Reuters report. The Commerce Department's Bureau of Economic Analysis reported that the gross domestic product, GDP, rose at an annualized rate of 4.9% last quarter, the highest since the fourth quarter of 2021. Economists surveyed by Reuters had forecasted a 4.3% increase in GDP, indicating that the actual growth surpassed expectations. In comparison, the economy grew at a 2.1% pace in the April-June quarter. It is expanding at a pace well above the non-inflationary growth rate of 1.8% that Federal Reserve officials consider. Despite concerns about aggressive interest rate hikes by the Federal Reserve, the robust growth observed in the third quarter demonstrates the resilience of the US economy. However, there may be a potential slowdown in the fourth quarter due to strikes by the United Auto Workers and the resumption of student loan repayments by millions of Americans. Nevertheless, most economists have revised their forecasts, believing that the Federal Reserve can successfully engineer a soft landing for the economy. They cite the strength in worker productivity and the moderation in unit labor costs growth during the second quarter, which they expect to have carried through into the July-September period. Consumer spending, which accounts for more than 2/3 of the US economic activity, played a significant role in driving the growth. The strong labor market has provided a solid foundation for consumer spending. Although wage growth has slowed, it is still outpacing inflation, thereby increasing households' purchasing power. The Labor Department's separate report on Thursday highlighted the resilience of the labor market, revealing that the number of people filing new claims for state unemployment benefits rose slightly to a seasonally adjusted 210,000 during the week ending October 21st. The recent GDP data is unlikely to have any immediate impact on monetary policy, given the surge in US Treasury yields and the stock market sell-off, which have tightened financial conditions. Financial markets anticipate that the Federal Reserve will maintain interest rates at their current level during the upcoming policy meeting on October 31st, November 1st, according to CME Group's FedWatch. Since March, the US Central Bank has raised its benchmark overnight interest rate by 525 basis points, resulting in the current range of 5.25% to 5.50%. The intricacies of this economic puzzle are vast and complex, but don't worry, we're about to unravel them. It is indeed a perplexing situation, but as we delve deeper, you will find that the two are not as contradictory as it appears. To understand this paradox, we first need to comprehend what makes an economy strong. A robust economy is like a well-tuned orchestra, each instrument playing its part in harmony. And in this financial symphony, there are several key players. First, we have gross domestic product, or GDP growth, the broadest measure of economic activity. It's akin to the conductor of the orchestra, guiding the overall performance. The recent quarterly GDP growth in the US has been impressive, hitting a high note that we haven't seen in nearly 2 years. Next, we have the unemployment rate, the rhythm section, if you will, keeping time and setting the pace. A low unemployment rate indicates a healthy job market, which in turn leads to increased consumer spending. Speaking of consumer spending, it's like the melody of our economic orchestra, driving the tune forward. When consumers are confident and spending, businesses flourish, leading to increased business investments, the harmonious backing to our melody. All these factors, robust GDP growth, low unemployment rate, healthy consumer spending, and strong business investments, are currently playing in harmony in the US economy, creating a symphony of economic strength. Despite these indicators of a robust economy, the stock market is not reflecting this strength. The question is why? Now let's shift our focus to the stock market, which seems to be dancing to a different tune. You might be wondering, how can the stock market fall amidst robust economic growth? Well, the stock market isn't a mirror image of the economy. It's influenced by a myriad of factors, some of which can cause a dip even in a flourishing economy. Firstly, the fear of inflation. When the economy is doing well, businesses grow, wages increase, and so does spending. This can lead to an increase in prices which can spook investors, causing them to pull out of the market. Next, consider interest rate hikes. Higher interest rates mean that borrowing becomes more expensive. This can decrease corporate profits and lower stock prices. In fact, the anticipation of rate hikes can send jitters through the market. Then we have geopolitical tensions. These can create uncertainty, and the stock market hates uncertainty. Any perceived threat to global stability can make investors nervous, leading to a market downturn. Finally, let's not forget about market corrections. The stock market can sometimes become overheated, with prices rising beyond what's supported by earnings. When this happens, a correction can bring prices back to a more sustainable level. So, while it may seem paradoxical, a falling stock market doesn't necessarily indicate a weak economy. It's a complex interplay of various factors. As we can see, a falling stock market doesn't necessarily mean a weak economy. It's a complex interplay of various factors. So where does this leave us in understanding the paradox of a strong economy and a falling stock market? We've navigated through the robust pillars that constitute a strong economy, such as the impressive quarterly GDP growth rate of 4.9%, the highest in nearly 2 years. It's clear that the US economy is demonstrating remarkable resilience and strength. Simultaneously, we've unraveled the mystery behind the falling stock market, peering into factors such as investor sentiment, global economic trends, and the influence of monetary policy. Despite the healthy state of the economy, these elements can still cause the stock market to stumble. The relationship between a thriving economy and a tumbling stock market is complex and multifaceted. They are two sides of the same coin, both reflecting different aspects of our financial system. Ultimately, while it may seem counterintuitive, a strong economy and a falling stock market can indeed coexist. It's just a matter of understanding the bigger picture.